Hello, class, and welcome to part 2 of the chapter M4 sample problems. So on this first problem, we are going to prepare a contribution margin income statement. So if you recall from watching your videos, a contribution margin income statement is a little bit different from a regular income statement. So both of them have the very first line as net sales revenue, right? But in a normal income statement, like a financial statement prepared for external users, we would have less cost of goods sold to arrive at gross profit. Then we would subtract from that our other operating expenses to arrive at operating income. And then from there, we might subtract like other non-operating expenses and taxes to arrive at net income. Okay, so that's a regular financial orientation income statement. Okay, now because we're doing this on a managerial side, we want to analyze this based on which of our costs are fixed costs and which are variable costs, right? So we learned about those types of costs earlier in the chapter. Now we're going to put this into a reporting perspective here. So the contribution margin income statement starts off with net sales revenue also, but then it's going to subtract all of our variable costs to arrive at contribution margin. Now, contribution margin is the amount that we are making off of our sales before we cover our fixed costs. So it's the amount of sales that are left in terms of income after covering the per unit costs. And these costs can be used to cover our fixed expenses and generate net income. All right, so after our contribution margin, we subtract out our fixed costs, and then that gets us to our operating income, okay? So over here, we're going to take our net sales revenue minus our variable costs to arrive at our contribution margin. And then from our contribution margin, we will subtract our fixed costs to arrive at our operating income. So here we've got tables selling for $100 per unit. So we need to figure out our variable costs in total here, right? So, and our sales revenue in total. So on a per unit basis, it's $100 per table and $40 per unit in variable costs. And then we're going to have $6,000 in fixed costs. And they want us to do a statement for 200 tables. So we're going to take our sales revenue per table of $100, multiply that times the 200 tables to get to $20,000 in revenue. And then our variable costs, again, we're going to take 200 tables times $40 per table in variable cost to get to $8,000 here. I'll just show you the formula here in case I'm going too fast. And then, so 20,000 minus 8,000 gets us to 12,000 in contribution margin, okay? And then we subtract the fixed costs from that. So 12,000 minus 6,000 is 6,000. And that gets us to our operating income. Okay, so we'll go ahead and fill that in. So the amount of operating income after we have covered our fixed costs is $6,000. All right, so what is the total contribution margin for 1 month when the company sells 200 tables? Well, we calculated that right here. It's $12,000. And the next question they're asking is, what is our unit contribution margin? Well, what we're going to do, we're going to take our net sales revenue per unit here, which is $100. and we are going to subtract our variable cost per unit to get to the unit contribution margin. So here 100 minus 40 is $60 in contribution margin per unit. All right, so once you know your unit contribution margin, by the way, then you can say, hey, what is my total contribution margin in dollars for any level of sales, just by taking that unit contribution margin and multiplying it times the number of units. Now, the next thing they're asking is, what is the contribution margin ratio? So the contribution margin ratio is the portion of your sales that generates contribution margin. So we take the unit contribution margin and we divide it by our net sales revenue per unit to get to our contribution margin ratio. So our unit contribution margin of $60 divided by the $100 net sales revenue per unit gives us 60% contribution margin ratio. Okay, now for our next question here, we've got a furniture manufacturer that specializes in wood tables. The tables sell for $100 per unit and they incur $40 per unit in variable costs. Company has $6,000 in fixed costs per month. So we're trying to calculate a break-even point. So what we need to do is the general formula here is to take your fixed costs plus your target profit and divide that by your contribution margin per unit. And that will tell you how many required units you have and how many units you need to sell, essentially. So our fixed cost plus our target profit gives us, so basically we're backing into down here, right? Like if we were to take 6,000 in operating income that we wanted to make, if we want to make $6,000, we'd take the 6,000 in operating income, add the fixed cost of 6,000, and that would tell us we would need contribution margin in total of $12,000. If we know that we have a contribution margin per unit, if we take that $12,000 divided by $60 per unit, then that would tell us that we would need to sell 200 units in order to reach that level of income, okay? So in this example here, so those are the numbers from the previous problem, but here we've got fixed costs of $6,000, and they're asking us to calculate a break even. So a break even, we can use this same formula, but just say, hey, our target profit is 0. Because at a break-even level, we're not making any profit and we have no loss. So a target profit of 0. Now, let's see, tables, $100 per unit, $40 per unit in variable cost. Let's see here. So they're saying, oh, we did that previous example, but now they're saying if our variable costs increase by $10 per unit, then that would give us, so right here, let's say we had this situation, 100, only now we've got a cost of $50. I'm just going to delete these out of here for now since we're not using those numbers. That would give us a contribution margin per unit of $50. So 100 minus 50 is 50. So our costs went from $40 to $50. So that means that if we have 6,000 in fixed costs and a target profit of 0, we're going to take 6,000 divided by 50. And that's going to tell us we need to sell 120 units here, okay? So they're doing some what-if scenarios here to figure out, well, what would happen if this happened? All right, well, what happens if our fixed costs go down by 600? Okay, well, instead of 6,000 in fixed costs, we now have 5,400. And so we're putting this back to our regular one here. So that would give us a contribution margin per unit back to $60. So 5,400 divided by 60 units gets us 90 units that we would need to sell. Okay. All right, and then next example, what happens if our sales price increases by $10? All right, well, I'm just going to put the formula in here. So C14 minus C15. Okay, so if our sales go up by 10%, I'm going to put equals 100 times 1.1, which means that we'd have a $110 sale price. When we subtract our $40 cost, that gives us a contribution margin of $70. And again, we're back at our base scenario for fixed costs with zero target profit. So 6,000 divided by 70 gets me 85.71. And let's see, round the break-even point up to the nearest whole unit, because we can't sell a partial unit, right? So 86 units we would have to sell. Okay, so for our next problem here, we've got the furniture manufacturer again, and they also want us to calculate margin of safety. Now, margin of safety is how many units we have in terms of extra units beyond our break even, right? So if we're looking at this again here, we got the same numbers here with $100 in sales revenue per unit, $40 in variable costs. And they want us to start by calculating a margin of safety in units. Actually, wait, hold on a second here. Where am I? Okay, so first we have to calculate our required sales in units, just like we did in our previous problem. Sorry, had to read that for a second. So the first step to calculate margin of safety in units is to figure out the number of units we need to break even. Okay, so we're going to take our fixed costs, which are $6,000, and we are going to divide those, or I'm sorry, add to that our target profit, divide that by contribution margin per unit, just like we did in the last problem. So $6,000 in fixed costs with a break-even profit level here and $60 contribution margin per unit. We figured this out in the last problem. Our required sales in units is 100 units. Now, for the margin of safety in units, we're going to take our expected sales level, which is 200 tables per month, and we're going to subtract from that the number of units we need to break even, so break even sales. So if our expected sales are 200 and our break even sales are 100, that means that we have a margin of safety of 100 units between what we expect to happen and what we need to break even. Now, next they want us to calculate degree of operating leverage. Okay, so degree of operating leverage. To calculate that, please make sure you watch the video on degree of operating leverage. We're going to take our contribution margin here, and we are going to divide it by our operating income. So how effective is our contribution margin at covering our operating income? And our contribution margin here at 200 sales, or 200 units, is $12,000. So contribution margin in dollars. And our operating income at that level with 6,000 in fixed costs was $6,000. So 12,000 divided by 6,000 gives us a degree of operating leverage of 2, which means that we are covering our fixed costs 2 times to arrive at our operating income. Okay, now the last part they have here is they want us to calculate the break-even point in units for each of these products. So now we have a product mix question here, though, because people tend to buy tables and chairs together. So we need to figure out a combined contribution margin for these items. All right. So I'm going to plug in the numbers that we need for a contribution margin income statement are the sales price per unit minus the variable cost per unit to arrive at contribution margin per unit. And then you take that contribution margin per unit and multiply it times the sales mix. So the ratio of how many of one items you tend to sell in comparison to the other item. And that will give us a combined contribution margin, okay? So sales mix in units on this line. So in terms of tables, right? Tables sell for, let's see, chairs sell for $50 each and have a variable cost of $30. And we said that tables up above sell for $100 with a $40 variable cost. So that means for an individual table, we have, again, $60 contribution margin. For the chair, we have 50 minus 30 or $20 contribution margin. But we tend to sell one table for every 4 chairs. So I'm going to put one table here, 4 chairs here. Total units, we don't care whether it's a table or chair, just the number of units is 5 units, okay? So now, with the contribution margin here on a typical sale, we have 1 times 60, which is 60. We have 4 times 20, which is 80. So in total for this package, we have 60 plus 80, which is 140 for a typical sale of 1 table and 4 chairs. So then if we take the $140 and we divide it by the 5 units, that gives us $28 per unit in terms of weighted average contribution margin per unit. Okay, and this problem just keeps going, right? So now we want to calculate a break-even point in units for the package of products with 1 table and 4 chairs. So we're going to take the same formula where we take fixed costs plus a target profit and divide it by a contribution margin. Only this time we're going to use the weighted average contribution margin per unit, okay? So in that sense, then again, we've got, let's see here. If we sell chairs, they said, our fixed costs go up to $7,000 per month. So we have a revised fixed cost here of $7,000. And again, we're looking at a break-even scenario, so 0 for target profit. And we're going to take that and divide it by our weighted average contribution margin of $28 per unit. So 7,000 divided by $28 per unit gets us to 250 units that need to be sold, okay? Now, the next step then is figuring out like how many of each individual units we have in each of these combined units here, right? So we need to take the break-even units for the package that we just calculated. And we're going to multiply that times the proportion of the sales mix that each of those items is, okay? So in total, we said 250 units, right, is the number in total. And the mix of that is going to be, so we've got 5 items. 1 of those 5 items is a table and 4 of those items is a chair. So 1/5 is for the table and 4/5 is for the chairs. So 250 times 1/5 is 50 tables we would need to sell. And then 250 times 4/5 is 200 chairs. So in terms of combined sales mix, we would like to sell 50 tables and 200 chairs in order to break even. Okay, so for our next question, this is just looking at variable, fixed, or mixed costs. And so we're going to examine these cost behaviors and determine, are these variable, fixed, or mixed? So what makes up a variable cost? It means that it increases at an even rate based on the number of units here, okay? So I'm going to copy these here. Actually, here, let's put phone, materials, manager, and number of units, 25, 50, 75, 100. And we've got a mix of costs here. So the easiest one to figure out here right off the bat is we know that fixed costs do not change based on the number of units. So we've got the manager's salary is the same across the board. So I'm going to just go right out here and say that one's a fixed cost because, and let's see, what is our list of reasons here? Does not change in total over wide ranges of volume. Okay. So it does not change in total. I'm going to go for 1 there. All right, now materials cost per unit is the same amount per unit, 35. So for every additional unit, it will go up by $35. So that tells me that that one is a normal variable cost because it's the exact same per unit, okay? So let's see, directly proportional to the number of units produced. Total cost changes as volume changes and in direct proportion. All right, and then the phone cost we have for 25 phones, it's 150, and it's going up $50 for each 25 units. But if we say, how much is this going up? It's going up $50 for 25 additional phones, which means it's going up $2 per unit or here. But if we look at this, $2 times 25 is not 50. So there must be a base fixed cost in here. So to me, that says that that one is a mixed cost. And that says the cost changes as the volume changes, but not in direct proportion across all the units there. I like how they gave us an answer 4 here, and there isn't even a 4th one on here. That's hilarious. Okay. All right. Okay. Now, depreciation cost per unit here. So 60 at 25, 30 at 50. Okay. So this is inversely changing, which tells me that the cost is going down per unit here. It's not going up per unit. So to me, that tells us that this is a fixed cost. And it says on our list of reasons here, does not change. It's inversely proportional to the number of units here. So that's number 1. All right. Total utility cost, 400, 650, 900, 1150. So this goes up for 25 units. It goes up $250. In theory, then this should be 250 here. So this has to be another mixed cost where we've got like a base fee, and then it goes up on a per unit basis after that. And then cost of goods sold. So 31.25, 62.50, 93.75. Okay, so let's see. Is this one is exactly 3 times this one. And this is exactly double that one. So this is going up proportionately. So this is just a classic variable cost. So as the number of units doubles, it goes up. It also doubles. Or if we say the amount per unit, right? So 31.25 divided by 25 is 125. And then here, if I take 62.50 divided by 50, again, 125. So the amount per unit is the same across all of those. So directly proportional again. All right. Next problem we have here is a contribution margin per unit. Oh, all right. Well, this should be easy enough. So contribution margin per unit is calculated by taking your net sales per unit minus your variable cost per unit. we've got a company that makes socks with fixed costs, which we don't care about because they're not part of our contribution margin. Contribution margin is just the sales and the variable costs. Variable costs are 81 cents per package, and each package sells for $1.80. So that gives us a contribution margin per unit of 1.8 minus 0.81, which is oops, hold on a second here. 108, 180. Oh my gosh, Erica. Okay, 1.8 minus 0.81. There we go, 99 cents per unit. All right, and then it says, enter the amounts to calculate the contribution margin ratio. Okay, so we take our contribution margin per unit here, and we divide it by our net sales per unit to get our contribution margin ratio. So 0.99 divided by 0.81, or I'm sorry, $1.80s are sales here. So 0.9 sales revenue per unit is $1.80. That gets us to 55% or 0.55, okay? The next one is another required sales in units again. So remembering from our previous problem, fixed costs plus target profit divided by contribution margin per unit gets us our required sales in units. We have fixed costs of $91,080, and they want us to calculate break-even point, which is a target profit of 0. We divide that by our contribution margin per unit of 99 cents, and that gets us to 92,000 units. All right, and then they're asking us to find the break-even point in dollars. So we are taking our fixed costs here, plus our target profit divided by our contribution margin ratio to get the required sales in dollars. So 91,080 plus 0 target profit divided by our contribution margin of 55% gets us to $165,600 in sales to break even. Okay, we're getting on the home stretch here. This is a lot of problems on this one, but I'm sure you're still hanging in there. Okay, so Nolan Rouse is considering starting a web-based educational business, ePrep MBA. He plans to offer a short course review for accounting students in MBA programs. Materials would be available on a password-protected website. Students would complete the course through self-study. Rouse would have to grade the course assignments, but most of the work would be in developing the course materials, setting up the site, and marketing. Unfortunately, his hard drive crashed before he finished his financial analysis, but he did have a partial chart that he had put together here. So what this tells us here, I can tell by looking at this. Okay, so the green area is where he would be making a profit. The yellow area would be where he would be not making a profit. And where your two lines meet here, you would have your break-even point, right? So these are the costs that we have here, and these are the sales numbers. And when the sales are more than the costs, then we make money. So let's take a look at these. I'm going to make this bigger because guess what? I cannot read it. All right, I might have to zoom these in here. Okay, so let's see here. They really made these tiny and messy. That's frustrating, isn't it? Okay, so the sales revenue line. Where am I here? Let me look at this one here, see what this looks like. So the operating income area is going to be over here. The break-even point is going to be in the middle, and the fixed costs are going to be or this is our total costs line here. Fixed costs would be flat, right? So the fixed costs are going to be at the baseline level here. So that looks like it's in the same spot on these. So we want operating income to be in the upper right. We want our total costs line to be this blue line right here. Let me take a look here and see. So the fixed costs are at this level. The cost line is here. Sales revenue is here. And let's see here. I think, yeah, that's not the operating income area down there. So it's got to be either this one or this one because the operating income needs to be in the top one. Anyway, sorry, I'm going to keep clicking on these until I find one. Okay, there we go. Operating income is up here. Total cost line here. Fixed costs is here. That's our break-even point. And I think they're labeling the sales revenue here. So I'm going to go with that one. This is a sort of a cluster, isn't it? It would be nice if they made that readable in that problem. Okay. But we got there. All right. So if Rouse attracts 300 students to take the course, will the venture be profitable? Let's see here. So if they have fixed costs at, looks like $32,000 here. I'm going to move this over so I can use my thing here. All right. So fixed costs of 32,000. And it looks like I'm going to look at this one because I can see without the labels, I can see it better. Okay. So it looks like our break-even point here is at 400 students. And they're saying, will we break even at 300 students? No, we will not, because the break-even point. So at 300 students, if we look at this here, that would be right here. Our sales are below our total cost line. So an operating loss would be happening. And the operating loss at that level looks like it is, let's see, 30,000 versus 38,000. So it looks to me like a loss of 8,000 there if only 300 students register. Yeah, the unlabeled one was way easier to read. Okay, so what was the break-even point? We can see that here it's at 400 students. And it looks like in terms of dollars in sales, that's at 40,000 in sales. All right, we're at the end here, last one. Okay, so now we're gonna do an absorption costing income statement versus a variable costing income statement. So the difference between these two is an income statement under absorption costing is like a financial format one. So if you remember when I looked at these earlier, we talked about how both of them start off with net sales revenue at the top, but on a financial orientation income statement, we then subtract our cost of goods sold, and then we would arrive at our gross profit down here. So under our cost of goods sold, we're going to have a mix of variable costs and fixed costs of goods sold. Okay. And then down below, we're going to have our selling and administrative expenses, some of which are going to be variable selling and administrative, and some of them are going to be fixed selling and administrative costs. Okay, so the difference here is that you could have a mix of variable and fixed costs up here to calculate your gross profit, and then a mix of variable and fixed costs down under selling and administrative to arrive at your operating income. So looking at our data here, all right, let's see if I can move this over so I can see this, plugging it in. 45,300, variable cost of goods sold, fixed cost of goods sold, and variable selling and administrative, and fixed selling and administrative. Okay, so in total here then, for cost of goods sold, we have 12,500 plus 11,800 to get us to a total of 24,300. And then if we take our sales minus our cost of goods sold, we get to 21,000. And then down here, our total selling and administrative gets us to 19,400. I suppose I could have just done that one in my head. It's all good. And then to arrive at our operating income, we're going to take the gross profit minus the selling and administrative. And that gets us to $1,600 in operating income. Okay, so that's an absorption costing income statement. It's the financial format, okay? Now, on the other side, they're asking us to put together a contribution margin income statement. So under the contribution margin income statement, we also start with net sales revenue, but then we subtract out all of our variable costs up here to arrive at our contribution margin. And then we subtract all of our fixed costs to arrive at our operating income. So we're going to have variable cost of goods sold and variable selling and administrative costs up here. Down here under fixed costs, we're going to have fixed cost of goods sold and fixed selling and administrative costs. So 45,300 here, variable cost of goods sold, 12,500, variable selling and administrative. So that gets us to 26,500. And then for fixed cost of goods sold, we have 11,800. Fixed selling and administrative, we've got 5,400. So that's going to get us to 17,200. All right, so now we're going to take our sales minus our variable costs to get to our contribution margin, which is 18,800. And then we're going to subtract from that our 17,200 in administrative costs to get us to the exact same $1,600. So same expenses, just rearranged a different way, where we're separating out the variable costs or the costs that change based on how many units we produce, and the fixed costs. And let's see what we have here now. One last problem here, I think, or do we have two more? Oh, two more still. All right. Another variable costing one here. Okay. So same format as before, net sales revenue and variable costs and contribution margin and fixed costs. Now I'm going to pause this for a second. Go ahead and fill this out like on your own, and then I will fill this in and then we will compare notes here. So pause the video. Okay, so here's what I came up with, all right? They gave us a sales price of $29. We sold 23,000 cases, so a total of 667,000 in sales. Variable costs were 9 for manufacturing and 3 for selling and administrative. Took each of those numbers, multiplied them also times 23,000 to get 207,000 and 69,000, total of 276,000. That gets us to a contribution margin if we take the sales minus those two variable costs of 391,000. They provided us with fixed costs of 91,000 and 9,000, total of 100,000. Subtract that out to get to 291,000. Now, we produced during the period 22,000 cases of powdered drink mix, and we sold 23,000 cases, of which 1,000 were produced in April. So we had 1,000 coming into May, and we produced 22,000 cases more, which means that we had a total of 23,000 cases. If we sold 23,000 cases, that leaves us with 0 cases, right? So beginning units, we had 1,000. We produced 22,000. Whoops. Units available was then 23,000, and then minus the units sold of 23,000 leaves us ending inventory of 0. Okay, so that's our income or our inventory formula there. Okay, so for this next problem then, we have the same general information here, but in absorption costing format. So we've got here net sales revenue, same revenue of 667,000 in this problem. And we are going to subtract out our cost of goods sold. So we had cost of goods sold, so variable cost of goods sold and fixed cost of goods sold. The variable we had was 207,000. The fixed, they told us, was the manufacturing related portion. Let's see here. So we had 97,000 or 91,000 for this month. Okay, so we got to watch out for this one, okay? Because we've got 91,000 for this month, but let's see here. In April, their production was 13,000. So this is our fixed costs for May, all of which we sold all of that product in terms of cost of goods sold. Now, for April, we had a production of 13. And so we're going to take, we sold 1,000 divided by 13,000 times our costs from April, okay? So 1/13 of April's fixed costs are also going to get assigned into this month because we sold 1,000 units from April. Okay, so here then, we've got fixed costs here then of 98,000 here, okay? All right, so in this situation then, so our total cost of goods sold is 207,000 plus 98,000. Whoops, put an equal sign there, Erica. 305,000. All right, so that then gets us to gross profit of 667,000 minus the 305,000, which gets us to 362,000. All right, so now down here, we are going to have selling and administrative costs. We're going to have variable selling and administrative, and we're going to have fixed selling and administrative costs. All right, so our variable selling and administrative costs, let's see, $12 per case. Let's see, we had that last time, sorry, 69,000. Now, in terms of fixed selling and administrative here, let's look at this. We have the same $9,000 here, okay? So 69,000 plus 9,000 gets us 78,000. And so our operating income is the 362,000 minus 78,000. Okay. Okay, so the operating income method here, so here we have the variable costing method here, had income of 291,000, and here we only have 284,000, which is less than the operating cost under the variable method. That's because we had that additional $7,000 in fixed manufacturing costs that have been allocated to the $1,000 of April inventory that were not included in the variable cost method. Because under the variable cost method, those fixed manufacturing costs would have been included in the previous period. So there can be timing differences between these. And then again, same thing, we had 1,000 units left over from last time. And we will have 0 units left because 1,000 plus the 22,000 we made got us to 23,000, all of which we sold. All right, and that is it for chapter 4.